I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite, and she's also the president of Venable Park Investment Council Corporation. Welcome back to the show, Danielle.
Hello, Jim.
The Bank of Canada boosted its trend-setting rate 0.5%. Is that enough to upset things in Canada? Was it overdue? What's your take on it?
Well, they've been talking about raising rates for some time. Let's not forget that they're only back to 1% as an overnight rate yet, Jim. In all the 9 years since the financial crisis, they've only managed to get the discount rate back up to 1%. So that was considered, outrageously low in the bottom of the 2003 cycle when Alan Greenspan cut the U.S. rate to 1% and left it there for a year. So we're continuing to be in this crazy land of insanely low rates and all the negative impacts that has on savers and productive investment throughout the economy. And so the Bank of Canada has been very concerned about the proliferation of financial bubbles in real estate as well as in high debt levels for households, as you know. And so they've been trying desperately to get to a tighter stance or a higher rate point before they have to confront the next cyclical downturn in the Canadian economy and the global economy. And they tend to be synchronized when they hit these days because of the whole financialization and connectedness of global markets. So when the next downturn begins, which should be any day now, we're basically at the second or third longest cycle ever. So at some point you're really pushing your luck when you think you can continue to keep the expansion going much longer here, and still central banks are at this, crisis point where they want to get more room between them and the zero bound so they can cut rates more if needed in the next downturn. And it will be needed because they've built this whole economy back up on the steroids of debt abuse. And so, in order to keep growth going, in order to keep consumption going, which is, it's about 70% of the U.S. economy consumption in households, and it's been as high as 90% in the past couple of years in Canada, which was way off the charts, and that was all enabled by debt. So of course they've wanted to raise rates. They used the opportunity to do so, but I have watched these cycles a long time, and here's the problem. We are a feeder fish in the global economy, and when the United States or our major trading partner turns down in terms of consumption, we tend to get hit, quickly thereafter, especially when we have a surging loonie as we've had, a loonie that's gone up more than 10%. In the past several months. So that all crimps our exports just as our households are the most indebted. And as you know, we've had some retracement in the U.S., in the Toronto housing market, the greater Toronto area, so much farther afield than just Toronto proper. So all of that is, Canada's on shaky legs in terms of the economy, but you got a central bank, and they're not alone. The ECB, the Fed, they all want to be, have more cushion to work with heading into the downturn. Sadly, they left rates so low for so long that they haven't been able to create that. So I think it will, unfortunately, just that 0.25, you'd think, geez, that surely isn't a big deal. But again, when you've got this economy that's been predicated on rates of, 0.5% and 0.75 in the overnight banking system, and then you move them even just 0.25, that's an incredibly large percentage increase, right? And so you had the banks turn around and increase prime today. A lot of our rates in the Canadian economy are floating and consumer revolving, and they are often a function of prime plus something. So just increasing prime alone, again, when your savings rate has been about 4%, which is where we've been recently in Canada, when you've got household debt levels about 170% of disposable income, when you've got, more than half of your household wages just going to keep the shelter over your roof, you really don't have any flex in there for even modest increases in rates. And so I think it's it'll continue to slow, or let's put it this way, it'll continue to reduce the amount of discretionary income that Canadians have. I do think that, they felt they had to do it. And as I say, I've watched these cycles a long time, and the most likely response is they will hike and then quickly reverse as soon as consumption turns down. And I think that we're starting to see that, certainly in major economies all over the world, certainly in the United States. And we've seen this reduction even in the amount of consumption driven by the Canadian economy in the past few months. So as I mentioned, for a couple of years there, it was way elevated over long-term norms, where consumption typically drove about 60% of consumption of the Canadian economy going back to like 1961. Then we had this last couple of years where we became really heavily concentrated on household spending for shelter and associated costs. And then in the last 5 months, we've seen that mean revert again back towards 60%. So consumers are already pulling in even before this rate hike. And I think that that's a trend they're going to have to do, because as I've pointed out so many times, even if rates could stay at this level forever and never go any higher, without wage gains, which no one's got, right? The Fed was noting in the U.S. economy they're disappointed in the flat wages. I mean, there's no significant wage increases going on in the world. And so when you've got this much debt, even if rates stay flat, you're not going to be able to increase consumption. And that's in fact what we're seeing.
We'll have more with Danielle Park right after the break.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Glance Technologies owns and operates Glance Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the U.S. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the U.S. and GET in Canada. Find out more at glancepay.com.
Welcome back. We're chatting with Danielle Park. Danielle, with the prime rate being set at the big banks around 3.2%, can people who have money in their savings accounts expect to see more interest?
Well, you'd hope so. Typically, banks don't increase their deposit rates that they pay as quickly as they increase the amounts they charge on the debt side. So there's a period there where they are able to make a wider spread, but eventually, if the increases last in terms of policy in the system, then eventually people do expect to have some kind of compensation. But really, if you think about this past period, certainly since 2010, when the world central bankers decided to, extend the expansion cycle through the QEs, it has really been all about bailing out banks and building up their balance sheets. So every one of us has been thrown under the bus. Savers were all penalized. Capital has been, squandered and wasted. No respect, Rodney Dangerfield, no respect for savers in this system. And debtors and people that have taken on reckless leverage have been looking like they've got all the answers, So it's really been about extending debtors and the ability to borrow more and leverage more and penalizing savers. And unfortunately, we're still in that scenario right now.
Ontario saw the biggest rise in debtor problems. Is that going to continue, and what's been the cause?
Yeah, it was directly related to households getting into, too expensive of shelter, as I've said. But, we're not alone. That's Ontario and BC, as you know, in Canada, have the largest amount of household income going to just try and keep a roof. Households in other countries who have seen huge increases in the price of their shelter, and a similar boat, Australia being one. I put something on the blog today about the Australian, debt levels in that 19 to sort of 35 age bracket have about doubled in the past 12 years. So it's our worker bees, it's our young people, it's those who need to pay into the pot for social benefits, for health care, for tax, all that. They're the most encumbered right now because they've come out of school with massive amounts of debt, and they've got into these easy finance terms on new car loans, new auto leases that have, again, sound easy on the front end, but the reality is you're paying off this payment for years thereafter. And so you've got that on top of the student debt, on top of trying to get on the, quote, property ladder. So it's really, looked like activity perhaps in the front end, but for anyone that's aware of how these consumption cycles go, how credit cycles go, they realize that you're really just reaching into the future and pulling forward demand that you would have had down the road has been already spent. And so what happens, the future arrives and there's less demand in the system. So it's very interesting. If you look at, so we've built these consumer-dependent economies, and, the primary drivers of that, for example, in the United States, 45% of retail sales, which is this big, as I say, component of the economy, the biggest component of the economy, 45% of that spending was in autos, general merchandise and department stores and restaurants. And what we've noticed in the past couple of years is that people have not been able to increase their spending and, in fact, have begun to spend less. So this goes all back to trying to service what you've taken on in the absence of, decent wage gains, which are not likely to come in the system. The wage gains have not come because the companies have been all about reducing their overhead to squeeze their profits, rationalizing the labor force, bringing in more automation, all that good stuff has lowered the cost for the corporations. Great, but it's not allowing this wage gain to increase spending power. So what we're seeing now is that the auto industry, who's been a major firing piston in this economic machine since the 2008 recession, has really been flatlining. New auto sales peaked in 2016 and have been declining since. Meanwhile, you've got millions and millions of cars that have been put out on these easy lease terms, with great incentives and front-end perks to get people into brand new cars. The problem is that there's some 11 to 12 million cars now just in the U.S. alone coming off lease in the next 2.5 years. And this is on top of the fact that we already have record amounts of inventory. So this is suppressing the price of used cars, which have been falling now since 2014. And what that means is that you have a lower end or residual value on those leases as they come off. So this is going to hit the financial profits that have been, assumed by the leasing companies. They assumed that a car would come back in and its resale value would be X. And in fact, they're finding that it's 10 and 20% less than what they had factored in. And so this leads to, less profitability on the leases, but it also leads to more expensive payments in people that are now getting into new cars. So you've got all these things kind of squeezing into the middle, that are not only are cars going to be in less demand because of the push to automate autonomous shared transportation, which is all positive, but we have this massive amount of cars coming off lease that people are already super indebted, that they're going to have to pay more to drive and they aren't going to be able to afford it. So there's great pressure in that main sector, that auto sector, which, has been, motor vehicles and parts is about 20% of retail spending in the U.S., similar in Canada. Then you have restaurants, which is about 12%. Restaurants are all reporting that they have, first of all, they were dramatically overbuilt and they're serving the wrong food that's making everyone sick. very high in sugar and salt and all this good stuff, but that they are now, seeing a massive drop-off in their sales and their ability to bring customers in the door. So those two things, motor vehicles and restaurants, is about, 32% of the retail spending mix. And then, of course, we've talked before about the merchandise, general department stores, that sort of thing, and how it's in a major downturn. And that's not just Amazon and online retailers, taking business away from bricks and mortar. It's also just consumption fatigue. Consumers have bought so much. They are, really feeling the weight of little savings and too much debt. At the same time that they're aging, at the same time they're just trying to figure out ways to do more with less. So all these things are really coming at the same time to put a lot of downward pressure on this retail spending sector, which is a huge component of the consumption that everyone's been banking on continuing, all at the same time that you have a natural cyclical end. Even if this wasn't the greatest credit cycle that we've ever seen in human history, and it is, you would come at some point to the end, as you always do in these cycles, to the end of that ability to add on more debt. And when you do, that's when you get the pullback period, which in highly levered circumstances like we are right now, and in the financial markets being highly levered, it typically brings a recession and a bear market in risk assets, and that's everything from stocks to corporate bonds. And then once the asset portion of the balance sheets begin to decline, it's like the water receding, and you're just left with the debt portion, both on the corporate balance sheets, on the households, really across the board. And that's when everyone realizes that this has really been a Ponzi scheme of sorts. It's been a sort of internationally endorsed Ponzi scheme that the central bankers and the banks schemed up after the financial crisis to try and refloat and, reinvigorate themselves. And they've been successful at that, but only in so much as these asset values continue to, cover up the ugly bits. Once the capital starts to recede from those asset values and people realize that they're back to where they started, 10 and 12 years ago in terms of value, they're going to realize that this has been a scam. And then I think we're going to have another period of, demand for change. And it's very interesting to watch the Trump administration, right? And the exuberance in the fall after he was elected, and the belief that he could bring in these sudden tax transformation and this quick kick, that would fix the economy and all that. And of course, none of that was true. It wasn't likely to happen. But as things have gone on here, as for example, yesterday a story in the Wall Street Journal that's saying he's no longer, happy with Gary Cohn, the ex-Goldman Sachs exec who he'd brought in as an economic advisor and who was hoping to take over the chair job at the Federal Reserve. So you've got a lot of exodus of these central bankers. I say getting out of Dodge, so they really tried this playbook since the financial crisis, which has, as I say, saved the banks for a while longer, but at the expense of so much else. And now people like Stanley Fischer suddenly steps down from the Federal Reserve yesterday, and Janet Yellen's hinted at Jackson Hole she doesn't want to extend her term past February. You've got something like 3 of 7 board members sitting, or will be as soon as when Stanley Fischer leaves. So you've got this exodus of these people who have been at the helm of this system for the past couple of decades, and they're all of similar age and ilk and sort of education. And so I think we're really setting up for a major changing of the world guard here. I think that it may be perfectly timed with the next downturn, which, as I say, reveals that people have sort of been had, and this hasn't been a sustainable solution. And you're going to get this, I call it creative destruction, not my term, but just it's the correct term economically. It means that you have this, revulsion or catharsis phase where these bad ideas and models are revealed as failures. You get a cleaning out of all that sort of rhetoric and thought, and a transition to a different approach. And I think the new approach will be about figuring out how to be more cost-effective, efficient, how to lower costs, not just how to add debt.
We'll have more with Danielle Park right after this.
Lotus Ventures Inc. is a BC-based medical marijuana company poised to launch into the rapidly evolving cannabis sector. Lotus is in the final review stage of the Health Canada approvals to become a licensed producer, having arranged facility financing of up to $12 million, plus building permits for its prototype indoor production facility. Shares trade under the symbol J on the Canadian Securities Exchange. Visit our website at lotusventures.ca.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're chatting with Danielle Park. Danielle, how soon do you think the robot cars will really hit the road? I understand in San Francisco, Google's already using them to ferry their staff around. Nobody's blinked an eye about that. And even the U.S. federal government now recognizes that self-driving cars are just around the corner.
Yeah, so we were talking about that, I think, in our last show, Jim, where we were saying that the governments of the world are really behind because this evolution of autonomous vehicles is happening so fast because of the, rapid acceleration in our computational ability from all these supercomputers. Everything is now coming in way ahead of schedule in terms of when people thought this change would be possible. And so every year now, the major players, the oil companies, the major autos, they're all sort of revising their timelines for what they had thought. They're increasing the infiltration of autonomous vehicles every year by, in some cases 30 and 40% increases in what they thought was likely to be the number of cars on the road and that sort of thing. So, sure enough, yesterday, the House of Representatives in the U.S., who's, typically unable to pass anything these days, was unanimously approved a bipartisan Self-Drive Act, and that is federal rules to limit the amount that individual states can control, how automakers construct and design these cars, and it also clears the road or the regulatory road for these cars coming on, and by all accounts within the next 3 years. So in one sense, it's a perfect solution because it brings these, more cost-effective transportation, lowers the cost dramatically, reduces the amount of cash flow that humans are going to need to spend out of their paychecks to get around from A to B, right? These are going to be, we've seen this in the car sharing services, but once you get autonomous, the cost is going to be that much lower where there's not actual drivers required to ferry people around. Now put in the electric piece where they're not required to use fuel. So now we've got, health benefits and improved air quality. And then you throw in the lack of parts and repairs needed and the fact that many of these cars are expected to go 1 million miles, Jim. So, 3 times, the prior lifespan expectation of old ICE engines. So, it's a perfect solution. It's going to free up tons of unnecessary roads and parking lots and all sorts of things that we currently have to support the current transportation system. Now, on the flip side of that, back to creative destruction, right? This means that a lot of the industries that are directly impacted, from the auto manufacturers to the, construction companies that make all these overpasses and roads, and to, on and on, gas stations, convenience stores, they aren't prepared for this transition because it's coming so fast for them as well. And, as we've discussed before, when something truly innovative hits, the typical human response is to deny it's going to happen or poo-poo it or say it's space-like and, sci-fi, it's not going to happen. And then it just keeps coming. And finally, by the time people are, realize it, it's already pretty ubiquitous. So it's within the next 3 or 4 years, we are likely to see this pickup in these autonomous vehicles. And that's, again, good news, lowering, for example, even healthcare costs, the amount of accidents, the amount of lost time at work. It's going to increase productivity. All wonderful, but not without great economic upheaval and disruption, because currently we have a world economy that fires on, as I say, this add, debt, and stir of consumption, and primarily, the most profitable companies in the world, what are they? It has been the big oil and the big auto and big food and big drug, right? That's the primary beneficiary. So at the same time, you've got to have a changing of the business model for all these, and the amount of companies that will be able to transition, that won't be paralyzed by their sunk costs and inventories of old materials that no one wants, that's going to be a major drag on our economic output before the cost savings and then the new investment cycle kicks in. And I think then we're going to have a great boom phase again in the world, but a smarter boom than the past 20 years when we've had, largely a lot of non-productive consumption on debt.
Danielle, thank you so much for chatting with us.
Hey, thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Sometimes you find better quality there. You can forward your questions for the show and our guests to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.